Good morning, students. Good morning.
Good morning, ma'am.
Good morning. So this is the last type of capital structure theory. Okay, this is a long one. This is quite a long one, and we need to understand this theory in depth. And most of the capital structure concept depends on this theory. Those three theory, other theories are also equally important, but in practical scenario, actually, to be honest, in the practical field, none of this theory has that much implications, because in practical scenario many things are so which has not been assumed by these theories. But theoretically, if you study the finance subject, then this is the theory which is mostly talked about. This is in other words the most popular one. Okay, but anyways, those other theories are also equally important. It's not that those theory has no base. In fact, this Modigliani-Miller theory has come from the concept of those three theories, and especially traditional and NOI approach. Okay, let's study in detail so we'll understand it better. So this pronunciation is Modigliani-Miller. In short, it is also known as MM approach to capital structure theory. Okay, those who are maintaining notebook, you can give the heading for today: the Modigliani-Miller approach to capital structure theory. These are the names of two persons. Okay, these are the names of two financial analysts who has discovered this theory, and this theory has been named after them: Modigliani-Miller approach. In short, we will call it as MM approach. So MM or Modigliani-Miller advocated that the relationship between the cost of capital, capital structure, and the valuation of the firm should be explained by net operating income approach by making an attack on the traditional approach. Okay, now yesterday when we were studying traditional theory, we found it to be more practical than the NOI or NI approach. Here in the Modigliani-Miller theory, they have focused more on advocating the relationship between the cost of capital, that is KW, capital structure, that is combination of debt and equity, and the valuation of the firm, that is capital V, that should be explained by NOI approach rather than traditional approach. They have supported NOI approach more. Okay, in the NOI approach or the net operating income approach supplies proper justification for the irrelevance of the capital structure. The NOI approach supplies proper justification for the irrelevance of the capital structure. In income approach supplies proper justification for the irrelevance of the capital structure. Same line has been written twice. Okay, anyways, printing error. So in the NOI approach, we could see the irrelevance of the capital structure, right? In NOI approach, we directly calculated the value of the firm by dividing EBIT by overall cost of capital. So this segregation of the debt amount and equity amount was completely ignored, and thus NOI approach said that they have justified also, this approach has justified also that the capital structure has got retail relevance in determining the entire value of the firm. It can be rather done by the earnings before interest and tax and the overall cost of capital. Okay. In this context, this MM has taken their propositions from this context itself. In this context, MM support the NOI approach on the principle that the cost of capital is not dependent on the degree of leverage irrespective of the debt equity mix. In the words, according to their thesis, the total market value of the firm and the cost of capital are independent of the capital structure. That means when you are calculating total value of the firm, this will have a little relevance to the debt equity mix. Whatever is the amount of leverage or whatever is the proportion of debt in the total capital structure, those things will be irrelevant when you are determining the total market value of the firm and the overall cost of capital. Okay, they advocated that the weighted average cost of capital does not make any change with a proportionate change in debt equity mix in the total capital structure of the firm. What they had again said, that this KW, that is weighted average cost of capital, will not change if the debt equity mix is changed. Just like NI approach, when we started with the theories, we started with NI approach, and there we saw that if you're increasing the amount of debt, the value of the firm is also equally increasing. But has anyone typed anything in the chat box? There is a sound coming in, but I cannot see the messages. From the morning it is happening. If anyone has typed anything, please unmute and tell me, okay? There is some technical fault in the chat box, I think. Anyways, so what I was saying is that in NI approach, we advocated that when we increase the amount of debt, the value of the firm continuously they were increasing, and as a result, the overall cost of capital was decreasing. But in NOI approach, it was seen that the weighted average cost of capital, that is KW, does not make any change. Will not change if the debt equity mix is changed in the total capital structure. Okay, and thus it can be shown as a straight line. KW, this was KD, KE, all those things were drawn in a graph, right? And it was more or less constant, KD and KW, if you remember. This can be shown with the help of a diagram, and this figure shows that the weighted average cost of capital does not make any change. And this was the first proposition of the MM hypothesis. They have based their theory on the basis of this proposition itself, which is coming from the net operating income approach. Okay. Now let us read the proposition. Remember, when you are writing MM approach in your copy, you should write everything elaborately. This comes as in the examination also as a note. So you have to be prepared with a theory. All the theories that we are studying now in financing decisions should be learned by you theoretically. It comes as theoretical question as well. And God forbid, if the situation sustains and you have to write written assignment, open book assignment for passing this semester also, then this theory portions will be mainly set for your assignments. Okay, so this theory, be ready with the theory portions equally. Whatever I am saying during the classes, know that this theory is important, this theory is important, should all be properly prepared by you, so that during the days before the examinations, you don't panic. Okay. So when you're writing the propositions of MM theory, you should write them in detail and understand them also for your own upliftment. We are going through a situation where even if you don't upgrade yourself, no one is going to question you. But for your own upgradation, for your own benefit, you should go on studying. You should go on understanding things which the teachers are teaching you, okay? Otherwise, your graduation will be useless. So deal with this situation wisely. Anyway, so let us start with the proposition. So the following propositions outline the MM argument about the relationship between the cost of capital, capital structure, and the total value of the firm. Okay, so number one, what does it say? The cost of capital and the total market value of the firm are independent of its capital structure. Same concept just like NOI approach. It says that is KW and V, capital V, are independent of its capital structure. They doesn't depend on the value of debt and value of equity. The cost of capital is equal to the capitalization rate of equity stream of operating earnings for its class, and the market is determined by capitalizing its expected return at an appropriate rate of discount for its risk class. So how this cost of capital is calculated? This is considered to be just equal to the capitalization rate of equity, that means KE. Okay, cost of equity. This cost of capital, that means overall cost of capital, is determined by equalizing it with the concept of KE, that is cost of equity for a particular risk class. Okay. And the market, all the market value is determined by what? It is determined by capitalizing its expected return at an appropriate rate of discount. Appropriate rate of discount, you know, it comes from again the concept of those discounting rate and all that. So at a particular rate, it will be inclusive of the inflation rate, rate of interest, whatever rates, important rates of interest or rates of any capital investment going on in the market, those rate will be capitalized and the particular rate will be considered, and then the market value of the firm will be determined by capitalizing or evaluating the expected return, and that will be discounted at a particular rate which is prevailing in the market. Depending on the market scenario for a particular risk class, that rate will be determined, and then the expected return will be capitalized in order to find out the market value of the firm. If you are confused at the moment, don't worry. While doing the sums, things will be clearer. Okay. All right. So second proposition says, the second proposition includes that the expected yield on a share is equal to the appropriate capitalization rate of a pure equity stream for that class, together with a premium for financial risk equal to the difference between the pure equity capitalization rate, that is KE, and yield on debt, that is KD. In short, increased KE is offset exactly by the use of cheaper debt. Second proposition says that the expected yield on a share, whatever the expected return is you are expecting from a particular share, is just equal to the capitalization rate of a pure equity stream, that is KE. Okay, together with a premium for financial risk equal to the difference between the pure equity capitalization rate KD and KD. That means whatever advantage, extra advantage that will be generated by including equity in the capital structure, that is increased cost of equity, they will be there. If you are incorporating more equity, that means more cost of equity. If you are incorporating more cost of equity, if you are having an advantage over that, because in the first proposition it is said that the cost of capital is just the cost of equity. Even if you are having an added advantage over this KE, that will be exactly offset by the use of cheaper debt. If there is an advantage, that will be equalized by the use of debt which has a cheaper cost. KD is always cheaper than KE, that we have understood. I don't know you remember or not, but due to that advantage, the increased KE will be offset by the use of this debt. Okay. And the third point says the cutoff point for investment is always the capitalization rate, which is completely independent and unaffected by the securities that are invested. What is the meaning of cutoff point for investment? This cutoff point for investment is the rate with which the investor actually decides whether to go for the investment or not. Okay, cutoff point in some sense, it can be also internal rate of return. Whatever is the rate of return, or you can also say expected rate of return, that is always the capitalization rate of equity which is completely independent and it is not affected by the securities that are invested. Okay. So how do this KE comes? This comes from the investment in equity, right? KE comes from the investment in equity. So whenever this equity is involved, then it is said in the third proposition that this whatever securities are invested, they are unaffected. They doesn't affect the cutoff point, which is the capitalization rate, that is KE. Then you should note down the assumptions of approach. Okay, the first assumption says existence of perfect capital market. What is the meaning of perfect capital market? It means there will be no transaction cost, which is not practical. There has to be transaction cost, there has to be service charges. Otherwise, shares and securities cannot be floated in the market. So their first assumption, which says that there exists a perfect capital market. Under this, it includes that there are no transaction costs. Next is flotation costs are neglected. Whatever charges are related to the flotation of the equity in the market, there are charges, right? Brokerage charges, then service charges, all these charges are there. But approach completely ignores that, neglects that. They say there is no existence of those type of costs. Third point is no investor can affect the market price of shares. Third point says it won't happen that if an investor, say it is an institutional investor and they are buying bulk stocks, still the market price of the shares will not be affected. They are saying that. This proposition is saying that no investor will be able to affect the market price. Fourth is information is available to all without cost, which is also not true. Their assumption says that information which is flooding in the market, they are available to all. It is not so, right? How come you're going to know the information related to the change in repo rate, which is going to come tomorrow? You can't know, right? As an investor, as an individual, you can't know. But their assumption says that information is available to all, with that too without any cost. Then investors are free to purchase and sell securities. Investors doesn't have any regulations. Investors doesn't have any bar on the purchase and selling of the securities that they hold. These are all coming under the first assumption, where they have assumed that there actually exists a perfect capital market. There does not exist a perfect capital market, okay? In practical scenario, there does not exist a perfect capital market, but their assumption says that there exists a perfect capital market. Second is homogeneous risk class or equivalent risk class. What does it mean? It means that the expected yield or return have the identical risk factor. That is, business risk is equal among all firms having equivalent operational condition. This is to some extent correct also, because if you are dealing with similar type of product in the similar type of market and there are n number of firms, so all will have identical risk factor, right? Their business risk will be equal. So the second assumption says that there is prevalence of homogeneous risk class within the market. Third point says homogeneous expectation. All the investors should have identical estimate about the future rate of earnings of each firm. To some extent it is correct, to some extent it is not correct also, because investors have their own perception. They perceive things based on their own analytical skills. So it may not be true all the time. It says there is homogeneous expectation of all the investors. They should have identical estimation. They should have identical expectation about the future rate of earnings for each of the firm. It cannot be true always. Fourth point says the dividend payout ratio is 100%. This can never be true. It says that whenever the firm distributes its earnings in the form of dividend, they must distribute everything. They cannot keep anything as reserves and surplus. So the dividend payout ratio should be 100%. And the last point, which not at all exists. Taxes do not exist. They says taxes do not prevail. But in order to inform you, there is an hypothesis with taxes also. We will study that also. Okay. In the first hypothesis or in the first approach, there is no taxes. But in the second approach of hypothesis, there will be taxes. We will study that also. Okay. So that is, there will be no corporate tax effect, although this was removed at a subsequent date. This was the first hypothesis developed. After that, after a certain period of time, this point has been removed and taxes has been included. Now, what is interpretation? We will do till interpretation today. On Monday, we will do this arbitrage mechanism. This is a very interesting mechanism. Okay, we will do it on Monday. This is a very interesting mechanism where, you know, okay, I'll tell you on Monday itself. And there is an example also, very nice example. We will discuss this arbitrage mechanism on Monday. Okay. Now I'll finish off with interpretation of the hypothesis. The hypothesis reveals that if more debt is included in the capital structure of a firm, the same will not increase its value, as the benefits of cheaper debt capital are exactly set off by the corresponding increase in the cost of equity. So what does it say? The hypothesis firstly revolves that if more debt is included in the capital structure of a firm, this will not bring a increase in the value of the firm, because this benefits of the cheaper debt, because debt is cheaper. You can have loan at a lower rate of interest than the rate of dividend that you may have to pay to the equity investors. Okay. So this cheaper debt has a benefit, but this benefit will be exactly set off by the increase in the cost of equity. If you are increasing debt, the cost of equity will gradually simultaneously increase with the increase in the amount of debt, because investors will now demand more rate of return. So you will have to give them assurance of paying more return also. That is how the cost of equity will also increase. So if you are incorporating more debt, it's not that the cost of equity will remain same. The investor will start to perceive risk in your company, and they will also start to demand more. The expectation will increase. That is how, even if you are trying to get the benefit of having more debt in the capital structure, that will not happen. That will be exactly set off by the corresponding increase in the cost of equity. Although debt capital is less expensive than the equity capital, but hypothesis also agrees with the fact that debt capital is going to be less expensive than the equity capital. Okay. So according to the total value of the firm is absolutely unaffected by the capital structure when corporate tax is ignored. Okay. In the absence of tax, they are backing up this fact that whatever is the amount of debt and equity, because the benefits of more debt is being offset by the increase in the cost of equity. So there is no effect. Both are same. Even if you decrease the equity and debt, it will not affect the value of the firm. In simple theoretical term, you can say that according to Modigliani-Miller, without taxes, according to Modigliani-Miller hypothesis, without taxes, the total value of the firm is absolutely unaffected by the debt equity mix. Okay, understood? So you will jot down the proposition, you will jot down the assumptions, and then you will interpret the Modigliani-Miller hypothesis. That is your task. Okay. So in this weekend, you finish off till this one. Those who had not written till now, you should note down all the theories in your copy properly. Okay. I will see when we'll meet in the college. So till this you do, on Monday we will do this arbitrage mechanism. That is a very practical thing. Although all the things are not practical in that mechanism, still it is a very interesting mechanism. You will understand that in detail, okay? How you will respond to my calls of names, okay? Wait. Vijit? Abhijit?
Present, ma'am. Present, ma'am.
Abhijita? Anurag? Aryan? Ashish? Ashmita? Nibechna?
Present,
Devrupa?
ma'am.
Harshita?
Yes, ma'am. Yes, ma'am.
Ishika Chaudhary? Ishika Agarwal? Kajal? Kajal? Pasak?
Present, ma'am.
Khushi? Ashmita present, okay. Krizan, Mahima, Mamta, Mohit, Muskan Prasad,
Yes, ma'am.
Muskan Gupta,
Yes, ma'am.
Namrata,
Yes, ma'am.
Nidhi,
Present, ma'am.
Nitesh, Parnadeep, Pavan, Prashil, Pratiksha Chetri, Pratiksha Giri, Priyanka,
Present, ma'am.
Pooja. Wait. Okay. Pooja, then Rahul, Rajat, Ramkrishna, Rohit Bansal, Rohit Pandey, Sagar, Selina, Shalini, Shruti, Siddhant,
ma'am.
Saurav, Tobit, Supriya, these are never present. Okay, fine then. See you on Monday. Okay, finish your task. Yes, Kajal, I have given you attendance. Okay, bye then, huh?